The UK housing market just sent a signal that most people missed. Not dramatic, not headline-grabbing, but quietly unsettling if you know what to look for. In the latest autumn data, average prices didn't collapse, they didn't surge either. They drifted lower again. Not by much, a few £100 on paper, and that's exactly why it matters. Because housing markets rarely turn with crashes, they turn with hesitation. Over the past 2 months, national indices have started to show a pattern that's hard to ignore. Prices rise slightly, then fall back, then stall, then get revised lower. That kind of movement isn't noise, it's indecision, and indecision in housing rarely resolves upward. What we're seeing now is a market struggling to agree on its own value. After a modest rebound in late summer, October and November data point to renewed softness. Annual growth hasn't collapsed, but it has continued to fade. The average UK home still sits just under £300,000 by most measures. That headline number hasn't moved much, but the story underneath it has. London remains expensive in absolute terms, but momentum there has slowed more sharply than almost anywhere else. Prices are still above £500,000 on average, but transactions are thinner and reductions are becoming more common. Meanwhile, regional markets that looked resilient earlier in the year are also losing pace, not falling outright, but cooling. This isn't a sudden shock, it's pressure building gradually. And timing matters. Since the September data, the broader economic backdrop has weakened further, not dramatically but consistently. Employment growth has softened, vacancies are down, hiring intentions are weaker, wage growth is no longer accelerating. That combination doesn't trigger forced selling overnight, but it changes buyer psychology. People become cautious long before they become desperate. At the same time, policy has delivered little clarity. The autumn budget passed without meaningful housing stimulus, no major tax relief, no buyer support, no signal that demand will be reinflated. That absence matters. Markets don't just respond to action, they respond to inaction, and buyers noticed. Transaction volumes through October and November remained subdued. Sales are taking longer to agree, chains are breaking more often, survey failures are increasing. People aren't rushing for the exits, but they're no longer rushing in. There's also disagreement in the data. One index shows small monthly gains, another shows mild declines, a third is flat. To casual observers, that looks confusing. To experienced analysts, it's revealing. When indices diverge like this, price discovery is breaking down. Sellers are anchored to yesterday's values. Buyers are pricing tomorrow's risks. That gap always closes eventually, and historically it closes through time, not optimism. Mortgage conditions add to the friction. The base rate hasn't moved. Swap rates have eased slightly. In theory, affordability should improve. In practice, many lenders have kept rates higher than expected, not because funding is expensive, but because risk is rising. Arrears remain low, but they're no longer improving, and lenders price forward risk, not backward comfort. So while rates are described as stable, the real cost of borrowing hasn't meaningfully eased. For first-time buyers, monthly payments remain stretched. For movers, affordability calculations are tight. This creates a slow grind rather than a sudden stop. There's another shift that isn't being discussed enough. The mortgage market is becoming more selective, not just on income, but on property type. Flats with cladding histories, leaseholds with escalating ground rents, homes in areas with weak rental demand. These properties aren't collapsing in price, they're becoming harder to finance, and illiquidity is often the first stage of repricing. Now consider supply. Listings are higher than this time last year, not dramatically, but enough to change buyer behavior. Some sellers are testing the market after missing the peak. Landlords are quietly reducing exposure in weaker areas. Developers are slowing completions instead of cutting prices outright. The result is more choice, but less urgency, and urgency is what drives price growth. Regionally, the slowdown is spreading. Earlier in the year, northern cities were still posting strong annual gains. Those gains are now narrowing. Southern commuter towns that held up through summer are beginning to see outright monthly declines. This is no longer just a London story. It's spreading sideways, not collapsing vertically, and that's often how national downturns begin. Investor behavior reinforces this shift. Buy-to-let activity hasn't rebounded. Yields look better on paper, but tax treatment hasn't improved. Regulation hasn't eased. Capital growth expectations have been revised down. Professional landlords are no longer price-insensitive buyers. They're negotiators or they're absent. Cash buyers aren't stepping in either. In previous slowdowns, they provided a floor. This time, many can earn solid returns elsewhere with less hassle. Property has lost its unquestioned status as the default safe asset. That perception shift matters. Sentiment reflects it. Fewer people expect prices to rise over the next year. More expect stagnation. A growing minority expect modest falls. If you expect prices to rise, you rush. If you expect stagnation, you wait. If you expect falls, you negotiate. Right now, waiting dominates. That's why volumes matter more than prices, and volumes are telling a clear story. Sales happen only when pricing is realistic, and realistic now often means below last year's peak. Agents are adjusting language. Reductions are encouraged earlier. That wasn't happening a year ago. The market is fragmenting. Some sellers don't need to sell and withdraw if they don't get their price. Others will negotiate within limits. A growing group has to sell. Markets are set at the margin. Buyers don't need widespread distress. They only need enough motivated sellers to reset expectations. Mortgage approvals may stabilize, but completion rates are slipping. Deals are failing late. Down valuations appear. Chains collapse. Not panic, friction. And friction slows markets more effectively than fear. Energy efficiency adds another layer. Homes with poor EPC ratings are increasingly discounted, not for ideological reasons, but because future upgrade costs are now being priced in. This creates a two-speed market within the same postcode. Headline prices stay flat, quality-adjusted prices fall. Interest rates matter less than duration. Higher for longer changes behavior, even if rates don't rise further. People plan for persistence, not relief.
Household resilience exists, but it's uneven. Markets supported by concentrated resilience tend to stagnate, not crash, and they struggle to recover. Flat prices during high inflation are still a real decline. That reality takes time to register, but it changes behaviour. Renovations are delayed, moves are postponed, spending tightens. Housing stops amplifying growth. Developers respond by masking price cuts with incentives. This caps resale values nearby. Macro conditions remain fragile. There's limited room for large-scale stimulus. Policy now prioritises stability over appreciation. London, which usually leads, is hovering, and hovering markets rarely resolve upward first. This isn't a crash, it's a recalibration, a market drifting sideways to down in nominal terms and declining in real terms. Liquidity is patchy, quality matters, negotiation replaces momentum. For buyers, this is a market of patience. For sellers, a market of realism. Housing is no longer a growth engine, it's a stabilizer, and that's the real shift. The market isn't breaking, it's bending, and when housing bends under sustained pressure, it doesn't snap back quickly. The era of effortless price growth is over. What comes next will be slower, uneven, and driven by fundamentals. The next phase won't reward speed, it will reward judgment. And that's the message hidden inside these quiet, unremarkable monthly numbers.